What's up, everybody? It's Financial Freedom here. Listen, when it comes to building long-term wealth, one of the smartest moves you can make is investing in ETFs. And today, we're diving deep into the top 5 ETFs you can buy and literally hold forever. We're talking about setting yourself up for financial stability and hitting those long-term goals. This video is your ultimate guide, whether you're just starting out or you've been in the game for a while. We're breaking down why these specific ETFs made the cut, the benefits they offer, and how they can be the foundation of a killer investment strategy. I'm talking about a diversified portfolio that can weather any storm and keep growing year after year. So if you're ready to build that financial fortress and watch your money work harder than you do, grab a notebook, hit that like button, and let's get started. Alright, let's kick things off with a true heavyweight in the ETF world, the Vanguard S&P 500 ETF, also known as VOO. Now this ETF is like the all-star team of the stock market, tracking the S&P 500 index. We're talking about 500 of the largest, most influential companies in the United States all in one basket. Think about it, companies like Apple, Microsoft, Amazon, Google, the giants that are shaping our world and driving innovation. When you invest in VOO, you're essentially buying a tiny piece of all of them. It's like owning a slice of the entire US economy, and that's a powerful thing. But here's the best part. VOO is incredibly low cost. I'm talking about a rock-bottom expense ratio that lets you keep more of your hard-earned returns. And trust me, over the long haul, those low fees can make a massive difference in your overall wealth. And let's talk about performance. The S&P 500 has a proven track record of delivering solid returns over the long term. I'm talking about historical averages that blow traditional savings accounts out of the water. Of course, remember, past performance doesn't guarantee future results, but VOO's history is definitely something to be excited about. Now, you might be thinking, Graham, why is this so important for long-term investors? Well, when you're in it for the long game, you want stability, you want growth potential, and you want to minimize your risk. VOO checks all those boxes. By investing in such a diversified basket of blue-chip companies, you're spreading your risk and reducing the impact of any single stock's performance on your portfolio. It's like having a safety net built right in. So if you're looking for a solid foundation for your portfolio, a set-it-and-forget-it investment that can grow steadily over time, VOO is definitely worth considering. It's like the bedrock of a well-diversified portfolio, and it's a must-have for any long-term investor. Alright, so we've covered the S&P 500 with VOO, but what if you want to take your diversification game to the next level? That's where the Vanguard Total Stock Market ETF, or VTI, comes in. This ETF is like the ultimate all-in-one package for US stocks. While VOO focuses on the 500 largest companies, VTI takes a broader approach, giving you exposure to the entire US stock market. I'm talking large cap, mid cap, small cap, you name it, VTI's got it. It's like owning a tiny piece of every publicly traded company in America. Now you might be wondering, Graham, why is this broad exposure so important? Well, think of it this way. Different segments of the market perform differently at different times. Sometimes large-cap stocks might be on fire while small-cap stocks are lagging behind. Other times it might be the opposite. By investing in VTI, you're not trying to time the market or pick winners and losers. You're essentially betting on the overall growth of the US economy. And history has shown that over the long term, the US market tends to go up. And just like VOO, VTI boasts a super low expense ratio, meaning more money stays in your pocket. Remember, those seemingly small fees can add up over time and eat into your returns. With VTI, you're keeping those costs to a minimum. Now, because VTI includes a broader range of companies than VOO, it might be slightly more volatile in the short term. But remember, we're talking about long-term investing here, and over the long haul, that volatility tends to smooth out. So, if you're looking for a single ETF that can give you exposure to the entire US stock market, VTI is an excellent choice. It's like a one-stop shop for US equities, and it's a fantastic addition to any long-term investor's portfolio. Alright, we've covered the US market, but what about the rest of the world? Listen, when it comes to building a truly diversified portfolio, you can't ignore international stocks, and that's where the Vanguard Total International Stock ETF, or VXUS, comes in. VXUS is your passport to the global market, giving you exposure to companies outside the United States. We're talking developed markets like Europe, Japan, and Australia, as well as emerging markets like China, India, and Brazil. It's like having a stake in the growth of the entire world. Now you might be thinking, Graham, why is international diversification so important? Well, for starters, it helps reduce your risk. By investing in different countries and regions, you're less exposed to the ups and downs of any single economy. If the US market hits a rough patch, your international holdings can help cushion the blow. But it's not just about risk management. International investing also opens up a world of growth opportunities. Think about it. Some of the fastest growing economies in the world are outside the United States. By investing in VXUS, you're tapping into that growth potential. And just like its domestic counterparts, VXUS comes with a low expense ratio, ensuring that you keep more of your returns. Remember, every penny saved on fees is a penny earned for your portfolio. Now, international investing does come with its own set of risks, such as currency fluctuations and political instability. But over the long term, the benefits of global diversification far outweigh the risks, especially for investors looking to build a truly resilient portfolio. So, if you're ready to expand your investment horizons and tap into the growth potential of the global market, VXUS is an excellent choice. It's like a one-ticket trip to diversification, and it's a must-have for any investor looking to build a truly global portfolio. Alright, so far we've focused on ETFs that provide broad market exposure, but what if you're looking for an ETF that can also generate a steady stream of passive income? That's where the Schwab US Dividend Equity ETF, or SCHD, comes in. SCHD is all about dividends. It targets high-quality U.S. companies with a proven track record of paying dividends to their shareholders. We're talking about companies that are financially sound, generate consistent profits, and are committed to sharing those profits with their investors. Now you might be thinking, why are dividends so important? Well, for starters, they provide a source of passive income. Instead of just relying on your investments to appreciate in value, dividends give you a regular stream of cash flow that you can use to reinvest, cover expenses, or simply enjoy. But dividends are more than just passive income. They can also be a sign of a company's financial health. Companies that consistently pay dividends tend to be more established and profitable, which can make them more resilient during market downturns. And just like the other ETFs we've discussed, SCHD comes with a low expense ratio, ensuring that you keep more of your dividend income. Remember, every dollar saved on fees is a dollar that goes straight into your pocket. Now, it's important to note that dividends are not guaranteed. Companies can cut or eliminate their dividends at any time, especially during economic downturns. However, by investing in a diversified ETF like SCHD, you're spreading your risk across a basket of dividend-paying companies. So if you're looking for an ETF that can provide both capital appreciation and a steady stream of passive income, SCHD is definitely worth considering. It's like a dividend-paying machine, and it can be a great addition to any long-term investor's portfolio. Alright, we've covered stocks, both domestic and international, and we've even touched on dividend-paying companies. But no portfolio is complete without bonds, and that's where the Vanguard Total Bond Market ETF, or BND, comes in. BND is your one-stop shop for bond market exposure. It invests in a diversified portfolio of U.S. investment-grade bonds, including government bonds, corporate bonds, and mortgage-backed securities. Think of it as the bond market equivalent of VTI. Now you might be thinking, Graham, why are bonds so important? Well, bonds play a crucial role in a well-diversified portfolio by providing stability and reducing overall volatility. While stocks tend to be more volatile and offer higher potential returns, bonds tend to be more stable and offer lower potential returns. By including bonds in your portfolio, you're essentially creating a balance between risk and return. When stocks are zigging, bonds are often zagging, which can help smooth out the ride for your portfolio and protect your capital during market downturns. And just like all the other Vanguard ETFs we've discussed, BND comes with a super low expense ratio, ensuring that you keep more of your bond returns. Remember, every basis point counts when it comes to long-term investing. Now, it's important to note that bonds are not without their risks. Interest rate risk is a major factor to consider, as rising interest rates can lead to lower bond prices. However, over the long term, bonds can provide a valuable source of stability and income for your portfolio. So, if you're looking to add some ballast to your portfolio and reduce overall volatility, BND is an excellent choice. It's like the shock absorber of your portfolio, and it's a must-have for any investor looking to build a well-rounded and resilient portfolio. There you have it, folks, the top 5 ETFs you can buy and hold forever. Remember, building long-term wealth is a marathon, not a sprint, and these ETFs can be the foundation of a solid investment strategy. Remember, diversification is key. Don't put all your eggs in one basket. By spreading your investments across different asset classes, you're reducing your risk and increasing your chances of success. And finally, don't forget to do your own research. This video is a great starting point, but it's essential to understand your own investment goals, risk tolerance, and time horizon before making any investment decisions. Knowledge is power, so empower yourself to make informed decisions about your financial future. As always, thanks for watching, and until next time, happy investing.